How much tax would a 71-year-old retired couple pay spending $150,000 a year in retirement? Hi, it's financial planner Sean Mullaney. Let's discuss. And this is actually a continuation from last weekend's video where I took a look at a 66-year-old married couple in retirement and showed that, they could be pretty affluent, spend $150,000 a year in retirement and pay zero federal income tax. Well, let's continue it. Let's fast forward to when they're both 71 years old. And the story isn't as good because now they're collecting Social Security. I'm positing $85,000 a year. And so they're going to start paying some federal income tax. But just how bad is it going to be? Well, all right, we're saying in 2024 numbers, they want to spend $150,000 a year. And they're taking home $85,000 in Social Security between the two of them. So they got to take $65,000 out of their traditional IRAs. I'm positing that they've now run out of taxable accounts. That may not be true. I mean, of course, this is just an academic exercise, so it's not advice for you, but it's an interesting look into, well, what if they had run out of those taxable accounts? So now it's Social Security and it's the traditional IRAs, right? That looks at an initial glance, that looks very inefficient, but is it? Let's take a look at their effective tax rate. Now, I put together their income tax return, and all right, I throw $600 of interest. Maybe they have like a $10,000, $12,000 savings account, emergency fund, fine. But otherwise, they have two income drivers, right? One of those income drivers is the $65,000 they take out of the traditional IRAs, and the other is Social Security. And recall, Social Security will be anywhere from 0 to 85% taxable. And there's a little calculation that we do to see, all right, how much of it is actually taxable. And I start here. I have a little, spreadsheet I did based on IRS publication 915 worksheet 1. You can get that on the internet. And I estimate that they will have $60,485 of their $85,000 Social Security would be taxable in this scenario. And I feel pretty good about that because I went to a website that Covisium has, I'll link to that as well, where I said, hey, you know what? Let's see how much Social Security would be taxed. They're coming up with the same number I am, so I'm feeling pretty good about that. Right, so let's go back to their tax return. I'm showing $126,000 and change of AGI. They get a standard deduction. They get an additional standard deduction. And on this $150,000 of spend, they pay $10,800 essentially of federal income tax by my estimate. That is an effective rate of almost 7.2%. They're doing awesome. That's really good. And this provides additional support for my thesis, often said on this YouTube channel, that retirees tend to be lightly taxed, even with traditional retirement accounts. But now you're probably saying, well, wait a minute, Sean, they're spending the $150,000, but now they have an additional expense, $11,000 in federal income tax. Not awful, but certainly not nothing. So what do we do there? And I think one number to show is this 93,000. Let me try to blow that up for you. They are right on the cusp of the 22% federal tax bracket. Okay, and they're in something called the tax torpedo. This is a real phenomenon in U.S. federal income tax. It's usually not as bad as advertised, but they've got these sort of two pain points, right? If they take out money from the traditional IRA to pay the tax that's due here, they're going to slosh into the 22% bracket instead of the 12% bracket. That's not a great outcome. And more of that Social Security is going to start getting taxed, right? Instead of $60,000, it might be more like $70,000. So we'll come back to that. So what I think they ought to do to pay just the tax, I would do a tactical Roth distribution here, right? Folks love to keep money in Roth IRAs, so it keeps growing tax-free for all time, and isn't that fantastic? Well, I do think there are times in our retirement that we ought to draw from the Roth instead of the traditional being tactical about it, saying, hey, you know what? I don't want to slosh into the 22% bracket. Maybe that last distribution, in this case for the taxes, maybe I just take that from the Roth IRA instead of the traditional IRA. Or I even do a strategy where I take some from the traditional, send that all to the IRS, and then separately take money from the Roth IRA. There are different ways you could arrange it, but I think taking the additional $11,000 in this case from the Roth IRA makes a lot of sense. And I'll sort of prove that out to you. Well, what if I take the additional $11,000 from my traditional IRA to pay the tax? Well, then you're creating more tax and more income, and you actually have to take $17,000 so that you pay all the new income tax in addition to the old income tax, in addition to our $150 of living expenses. What I prove out here with this little mini tax return here is, look at that. Their income tax goes up by $6,000. That's real money, right? But it's bad, but it's not awful. Because when you step back, you say, oh no, we increased the amount of tax that's subject to Social Security. That's now not $60,000 by my little spreadsheet. It's actually $72,000, it's 85%. So we're in that tax torpedo, and we're now in the 22% bracket, not the 12% bracket, if we pay the tax with the traditional IRA. So it's not great, but their effective rate is still only 10.2%. So, people worry about these traditional IRAs. They worry about things like the Social Security tax torpedo. And this is a couple living on $150, which in retirement is fantastic, right? In retirement, when you don't have commuting expenses, when you're not paying payroll tax anymore, you got a paid off home. If you're living off $12,500, sure, you're not a Rockefeller, but you're doing just great. You're probably taking one or two really nice trips a year, for example, maybe more, in order to have that level of spend in retirement. So even in the throes of the tax tornado for Social Security and having $82,000 of traditional IRA distributions, right, which is more than most people's RMD will ever be, but put that to the side for a second. At 71 years old, this couple, if they choose to do it inefficiently, will pay $17,000 in taxes for a 10.2% effective rate on their income. That's pretty dang good, and it shows you just how lightly taxed retirees tend to be, even if they're wildly inefficient. But that said, I would tell this couple, no, you have Roth IRAs. You were probably doing Roth conversions. You had other Roth IRAs. I would just take that money. If you recall the previous video, they had Roth IRAs. I would just take the money out of the Roth IRA, and then instead of $17,000 in federal income tax and a 10.2% effective rate on your total income, you're looking at a 7.2% effective rate on total income and more like $11,000 in tax. So what are the implications here, right? So one of them is, why are we so worried about traditional account contributions during our working years? Right, even if we're inefficient and we're paying or taking out $82,000 with a very healthy Social Security amount, our effective rate on income is still just 10.2%. So maybe having those traditional retirement accounts is a good thing, right? Not a bad thing, because remember, effective rate now is 10.2%. But when we were working, we were deducting into that 401k at 22%, 24%, 32%, 35%, maybe even 37%. So we're still winning that battle. Right. Second implication of my analysis is the Social Security tax torpedo is absolutely real and is something to be avoided on occasion, but it is not awful, right? We saw this taxpayer go through the entire torpedo, get to 85% taxation on their Social Security, be well over six figures in gross income, and they're still, or well into six figures of gross income, and they are still under 11% effective rate on their total income. That's pretty good. So the Social Security tax torpedo is not nothing, but it's also not something to lose sleep about, particularly when we're in our 30s and 40s during our accumulation phase. And then the last implication is, consider those tactical Roth IRA withdrawals to avoid higher tax brackets and reducing the tax torpedo. In this case, by taking a Roth distribution, we're saving something a little more than $6,000 in taxes just by taking a Roth distribution to pay the taxes. So I like that. So, it's not the end of the world to say on occasion, hey, in December, we're going to have one last distribution, or we have a tax bill due, or whatever it is. Maybe we just take from the Roth to pay that and avoid tax torpedo or avoid going into the 22% bracket or something like that. So do consider occasional Roth IRA withdrawals just to help make sure your tax picture is as optimized as possible. But even without the Roth IRA withdrawal in this case, it's not so bad. Those in their early 70s, even with relatively high Social Security, tend to be relatively lightly taxed in retirement. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.